Hey, Riz. You're muted, Riz.
Hi, Brett. How are you?
I'm good. So maybe we could start by just having you introduce yourself.
Okay. Well, first of all, thanks for having me on the podcast. So look
bet.
forward to the conversation. Ashraf Rizvi, everybody calls me Riz. Longtime Wall Street guy. Started after college, started trading FX derivatives in the floor in Philadelphia, and then ended up after 4 or 5 years at a few banks, Credit Suisse, Swiss Bank, and UBS. Did a variety of things there, FX derivatives. Ran various business streams, including emerging markets FX, fixed income repo for credit products, global metals and commodities. Got to do business with all sorts of clients, from high net worth individuals, family offices, the wealth management businesses, central banks, producers, consumers of commodities or FX products.
Yeah.
And then after I left what was Swiss Bank and then merged into UBS, took some time off. I spent a lot of that time in London, moved back to the US, started an asset management firm that catered to endowments, foundations, pension funds, as well as retail investors through public ETFs. Managed a few $1 billion in commodities for a variety of clients, ranging from retail to institutional, and then started a firm called Gilded that ultimately focuses on making physical assets digital. Not, I think I would say not crypto. It's really about melding the analog as well as the digital, where you have real title and ownership to the asset. In particular, we're focusing on gold to start and then can branch into other things. But it's really about making assets functional so that they can be utilized, benefiting from all the things that commodities benefit from, which is it's a real asset that you own. It belongs to you as title of property, just like your car, like your house, but that we can also make it functional and that you can be able to monetize it. You can be able to send it. You can be able to take a loan against it. You could do various things that make it start to behave like cash without having all the IOU exposure that cash typically has.
Right. So in some respects, this is kind of the opposite of crypto, right? Because in this case, I'm actually buying physical gold, and it's represented to me in a digital form. Is that right?
That's right. I think that's a good way to illustrate the point, is that yes, you're the owner of the physical asset, but unlike a crypto asset where it's everything is sort of purely digital and you don't have any analog, no real physical thing. You do have the physical thing here, but additionally, by virtue of having the physical asset, it's under the concept or legal concept of bailment, BAILMENT, which is a common law term, which means that the asset belongs to you, but it could be held by someone else. So a good example, practical example, would be when you check your luggage at the airline. That's common law of bailment because the luggage belongs to you, but they're temporarily holding it. Or when you valet your car, you didn't give that person your car. It's still your car. When you come back, you're going to get it. And the same can apply for, let's say, a gold bar or a piece of art. It could be sitting in a vault. It's not the vault's or whoever is the bailees, but it's yours. And whenever you want, and that could be the next day, it could be next week, it could be 50 years later, it's still your title and your property and your asset. In fact, it's also bankruptcy remote, which is very different than how when you deposit money in a bank works, because that money actually becomes the bank's money, not your money. It's an IOU that they give you. Whereas in the concept of the bailment, it's still your title, your property, even though it's being held by someone else. And so we're taking that analog and making it digital, so you get the benefit of both.
Yeah, that's super interesting. So a lot of people who have a diversified investment portfolio, probably own a little bit of gold, because that's often part of a fully diversified portfolio of investments. But having physical possession of gold is kind of a pain in the ass because it's big and heavy and stuff. And so, but there are plenty of gold dealers that I could buy gold from. So why would I buy it from Gilded? What's the benefit for me?
Yeah, so the value proposition is really taking a few things and putting them together. Sort of, I'd like to use the example of, an iPhone was sort of that. Is it took a number of things that you could do, but then it put them together. It took the concept of email, the
Yeah.
phone, a camera, and all of these, and put the ability to surf the web. So yes, you're right. So you could buy a gold ETF. You could buy physical gold through, there's hundreds, thousands of dealers
Right.
that you can go online. You could even go to a local store and do that. So all of those things you can do. And it's actually the way that most people accumulate the asset. It's about $11 trillion market size, so it's huge.
Huh.
And physical gold bars and coins account for about 5 trillion of it, and central banks hold 2 trillion of that. Another roughly 5 trillion is essentially jewelry, and then another trillion is in our laptop and desktops and our mobile phones and
industrial gold
usage.
Yeah.
So the innovation here is that one, a gold ETF, which tends to be dominated largely in Europe and in the United States, about $200 billion, is still a financial instrument because it's actually delivered through an SPV or a trust or a security. So it's a security.
Sure.
No different than a stock or a bond. The physical gold, which looks something like this, is real nice to have and great to look at.
Yeah.
But the problem is now I got to keep it and I got to take care of it. And, if it gets legs, as they say, or gets lost or stolen, there's nothing I can do about it, because ultimately this is a bearer instrument, just like $100 bill.
Yeah.
And if I lose it, then it's gone.
Plus it's a heavy sucker to carry around in your pocket.
It's a heavy sucker. And compared to my iPhone here, you can see that it's quite a bit, different sizes. So this is sort of impractical, but still lots of people own it, but you can't do anything with it. I mean, you could hit somebody in the head with it and hurt them, but you can't spend it and you can't use it in any way. And an ETF, of course, is a security. And a lot of people don't want to have a security because it's not your title, your property. Here, it's my title, my property, but I can't do much with it. So we're really trying to find the balance between the two, where you can actually have the instrument. This is the instrument you want, but it can be kept in a vault for you. And from that vault, you can do whatever. In other words, you can easily sell it. You can actually utilize it for a purpose. In other words, you could take a loan against it. You could turn it in any currency you want without having to sell it. So you could borrow against it. You could even pledge it as collateral, for example, to an exchange for trading purposes. So you can now utilize it in a way where it's leverageable, more like cash, without having the negative value of cash, which is that it's depreciating asset in all currencies because inflation's eating away at it. Whereas gold historically has done very, very well in terms of protecting people's wealth relative to inflation. So you get the functionality of the asset, you get the attribute that you want, you get the ownership rights, and you can do some of the things that you'd like to be able to do with it that you can do with financial instruments. Because if we all recall, we forget that in the 1900s, people used to keep the cash in their home as well.
Yeah, under the mattress.
Precisely.
Yeah. Okay, so I want to buy. Let's say I want to buy a bar of gold. And a bar is a kilo. Is that right?
That's right. The bars are typically, the most common instrument is this, which is a 1 kilo.
Okay.
And it's a little bit smaller than a standard size iPhone.
Okay. And the value of that today is approximately?
It's about $60,000 these days. So it's pretty expensive. Yep.
Okay. So I decided I want to buy a bar of gold, a kilo of gold, 60 grand. And my interest is store of value. And my interest also is hopefully some appreciation over time, right?
That's right.
And so I could go to my local gold dealer. I could buy a bar there. But then, as you said, that I got to figure out where I store it at home. Or I could just put 60 grand into a gold ETF, and I'm getting, more or less the same thing in terms of store of value and some measure of appreciation. But there is no good way to kind of leverage it in other ways. In other words, as collateral for a loan, or
That's
um,
right.
and so that's the principal benefit that I would get from
Yeah,
conducting
you
my
get the
transaction with Gilded. Yeah.
That's right. You get the functionality in that you could pledge it as a collateral for, trading on exchanges, to take a loan against it, still having the exposure that you get in the ETF, but other flexibility that you don't. You can even do some tax loss harvesting because it's a physical asset. So there's uh,
Ah,
physical assets don't have the wash sale rule, so that's very powerful.
oh, yeah.
And you can do it. Of course, what we do is we design technology to be able to do that. So it's a simple platform where you can go in, do the necessary KYC, make the purchase, wire the funds, and then we have it to the point where you can actually not only see the bar of gold, you can see the picture of every bar you own, the certificate of authenticity, et cetera. And so that's the important piece of identification that allows you to also then utilize it, because then it can be pledged to a bank for a loan, et cetera. So that's bringing what I'd call the analog and the digital together, in that
Yeah, yeah, yeah.
if you had the instrument yourself, you would physically have the possession. Here you have the picture and the certificates, which give you the evidence of the ownership rights. And then we, of course, we store that in distributed ledger technology, and we have it audited. And so everything that you'd expect to be done with third parties, so that it's not just us who's telling you that we have it. There's independent auditing. Obviously, the vault we're not the holder of the vault. We use a Brinks vaulting system. There's independent third parties who get independent reporting, independent auditing. There's independent parties who go into the vault, check that the gold is actually there. So you get all of that, and we evidence all of that for you, so that you can feel confident that it's your asset. It's still there. It was there last week. It's there next week. It's going to be there 5 years from now, and you still utilize it.
Yeah. I remember when I was a kid, and my mom opened a savings account for me at the bank, and whenever I got $5 from Grandma, I would take it down to the bank and deposit it into my savings account. And I was so incredibly disappointed one day when I found out that they did actually have a little, box back there where they kept my money. That they just simply took my money and used it for other things. I was so disappointed, because I imagined that every deposit I made was like going into a special Brett Waters box at the bank.
That's right. In this particular case, we do actually have the special Brett Waters box,
I
which is
know.
where your gold bar sits, which
Yeah.
is separate from Ashraf Rizvi's box. And to the story that you just mentioned, I'm reminded of the famous line, that supposedly was said. People asked Jesse James, "Why do you rob banks?" And he said, "Well, that's that's where the money is."
That's where the money is,
But
right?
the reality is, actually, banks don't have any money other than the ATM.
That's right.
There's really no money there. Everything is basically electronic. It's just a digital entry of Brett Waters' money that he
Yeah.
deposited there, and that's basically what's been going on for 100 years.
Yeah.
And the second point which you made, which is very important, which is, once you deposit your money, it becomes their money, and they get to do with it what they want. And if they
Right.
want to make mortgage loans or subprime loans, or invest in commercial paper or
Yeah.
whatever, they can do that. And we saw the implications of that in the financial crisis.
In 2008. So who's the typical Gilded customer today?
So it's interesting. We started originally a few years ago, and we really thought the initial use case was with retail
Uh-huh.
clients, and we built a mobile app to be able to cater to them, initially starting in India. And we went through the trials and tribulations that people do of building these. And that was a good use case, in that we got to see it in action. It, we got to see it actually work. We actually did everything end to end, where customers could go through, do KYC, AML, make a purchase,
Right.
own even a subset of a 1 kg bar. We could do fractional ownership down to as little as a gram, and that helped us really understand the marketplace. And we realized that actually the retail space was not for us. It was a singular product. It's much more, in tune with something like maybe more like what Robinhood or
Right.
others do, where
Right.
you sell multiple products. I sort of think of it as, it's almost like we're selling peanut butter. People don't usually go to one website to buy peanut butter. You go to Walmart or Amazon.
Right.
So they really, you go to a financial supermarket really to buy this asset. So we
Right.
started to over time morph into more and more into B2B and B2B2C. And that's where we are now, where typically now we're moving into and have moved into ultra high net worth clients who can afford to buy a $60,000 bar or more, millions of dollars, and who would like to own, who want to have something that's uniquely different than the ETF because they're concerned about the fact that they don't want to be tied into the financial system completely. Here, it's outside the financial system. It's sitting in the vault, but they still have access to it. They can have that functionality. And then, of course, the fact that they have, title and ownership rights to it. So it's really gearing more and more towards that. And then even more to, let's say, family offices or even institutional clients who, again, are trying to think about the fact that the bulk of their exposure, as you started the conversation, as part of their asset allocation tends to be financial instruments.
Right. So you said B2B2C. So I assume that means that, somebody, a high net worth individual might, have a relationship with a wealth management firm.
Yeah, that's right. Wealth
And,
managers, banks. That's right.
right.
Precisely.
And so you sell then to the consumer through something like a wealth management firm.
That's right.
Yeah.
Yeah, that's right. So we find the client through there, or we partner with a financial institution, and they say, we have a client that's interested in this. So it could be a referral, it could be they do it directly, but we have the ability to do it, soup to nuts. We can take the client on directly by onboarding them, or we could do it through a partner institution as well.
Got it. Yeah, so that makes sense because a lot of certainly a lot of wealth management transactions are very much based on a relationship, and so you have this terrific, very efficient, low friction platform, but somebody else may well have the relationship with the client, and so by selling this way, you can kind of offer your platform but still be leveraging the personal relationships that others have.
That's right. And so that comes back to that financial supermarket. So the firm might be the financial supermarket, whether it's a bank or a wealth manager advisor. They offer lots of solutions, but for certain clients, this may be a more appropriate solution than, let's say, a gold ETF or a physical ownership where they have the gold in their home or in their vault or in a safe or something like that. So it meets certain needs for that particular client. Obviously, the idea, of course, of the firm is you start with this one asset, which is well known, and then you branch to other physical assets that you can basically digitize as well. That could be a pair of sneakers, it could be baseball cards, it could be, of course, real estate, it could be art, it could be all these things, because the same basic concept applies as long as it's being held in a safe, secure way, can be audited, can be validated, but you know that you own that real asset ultimately is yours, but you don't have to worry about carrying it around with you, and you can access it through your mobile device or your laptop or your desktop.
So you mentioned that you started off thinking that the business model was going to be retail investors, small retail investors. Kind of bring and this is true for a lot of fintech players, right? That part of what fintechs often can do is they can kind of bring the power of financial services to the small retail investor who historically hasn't had access to them. And so you mentioned you kind of started out there and then you morphed to where you are today. And I'd love to hear more about that journey because in my when I teach at Stanford, I break a lot of hearts on the very first day when I tell the students that I can almost guarantee that their original startup idea is a fail because it almost always does. And what separates the winners from the losers are the ones who are able to, successfully pivot and find the right path after the original startup idea fails. So talk to us a little bit more about that journey for you.
Yeah, I think it's a really good point. I think it's a pretty fair statement that if your original idea is the one that succeeds, that's usually the the rarity and
That's right. That's
certainly
right.
not the common,
Right. Yep.
So this is my third startup. So first was trading on the floor, when I first started out of college, and it morphed into various iterations. Second one was asset management firm, same thing. What we thought we were going to do and what ultimately ended up being successful also morphed a bit. And this is the third time around, and again, I see the same thing. And so I do feel very confident saying about these things that whatever you started with, be very confident that's most likely not the right answer in the final part of the journey. It's just one chapter in the book.
Right.
And so I do think the retail experience was a chapter in the book, but it was an important chapter because you can't convince a institution, financial institution, or a wealth advisor that you've got a product if you haven't actually gone through the journey of having done it. And they're certainly not going to deal with you on day one because they say, why should I deal with you? You've got no experience. You haven't done it. You haven't shown me anything. So, the hard part, of course, on the retail is that you're trying to get mass number of clients with small amounts of money. And that's not easy to do. And it can have a lot of cost or expense in terms of CAC to do that.
Right.
So that's the negative side. The positive side, though, is those people who are true believers, early adopters, can quickly find their way to you, and you can do a lot of learning very, very quickly, and you can make a lot of mistakes. And if you make a mistake for somebody on $50 or $100, it's you can fix it.
Right.
You can fix it. So I think it was a very powerful learning experience. And I wouldn't change it because I just don't think you can jump right away to an institutional client. That's just not how it works.
Right.
So I think you learn a lot, you make a lot of mistakes, and none of those mistakes are typically fatal. And those learnings then can be leveraged to the next level because then you're starting to move to a higher ed audience. Of course, as that client becomes more and more sophisticated, more and more knowledgeable, has more wealth, they're going to be asking a lot more difficult questions, tougher questions. They have financial advisors, they have auditors, they have validators, they have all these other parties that are there to protect them because they can afford to be protected. And that's why I think, one of the things that we see here is that often the person who gets cheated the most is, of course, the little guy, because there isn't the only people who are protecting them is the SEC or CFTC or some regulator, and they can't protect all of them because lots of people can get around that. Whereas the wealthier client has lots of protections necessarily built in to the system. And so therefore, you have to have made a lot of mistakes and gotten all those things right to be able to cater to them, and because they're going to be a lot more diligent about making their purchase with you, because of course they're investing more money and they're going to have a lot more advice before they do that. So I think that's a natural journey in the chapters of the book that you have to go through. You start at sort of the basic level and you work your way up.
So I think a basic conundrum for entrepreneurs today is that on one hand, there's this mythology that great entrepreneurs stick to their vision no matter what. And on the other hand, we're told that that the correct startup methodology is to pivot and pivot fast. And so, trying to kind of figure out when to stay the course and when to pivot ends up being this conundrum. So, was it clear to you, kind of when it was time to pivot from the retail to the B2B and B2B2C? Was it clear to you?
I'm not, I think back to the three cases. I'm not sure it's ever really clear. I think that the signs are there and you have to kind of read them. I think what helped for us and for me was that we saw that the CAC for acquiring the clients was going down a lot, but we also saw that we were too one-dimensional to be a truly innovative solution with just a mobile app or app or for a singular product. Again, going back to that financial supermarket concept.
So you were kind of like a Robin Hood, but there's only one thing you could buy.
That's right. So yeah, sort of like selling peanut butter, no, it's just not, and not that there's anything wrong with peanut butter or jelly, but
Right.
you can go to Amazon and get 15 different flavors
Right.
or choices, or Walmart, et cetera. So I think those signs start to be there. And then I think also there's always some element of luck, and you stumble into certain things.
Yep.
So we stumbled into showing what we were doing to some financial institutions and some wealth management advisors. Said, that's cool. So, well, but what if I don't want to buy 1 gram? What if I want to buy 1,000 or 10,000?
Yeah.
Or, what about that? And so now it starts to get you thinking and say, wow, okay, now there's people who are interested in much bigger ticket sizes. That could be interesting. And say, well, what if you could do this? And so, I'm reminded by, many of the, the lean startup and some of these types of books that talk about this, which is the best learning experiences, go out and talk to clients.
Yep.
So talk to the clients, whether they're the little guys, and see what they're, they want to make
Yep.
up 1 gram purchase, 10 gram purchase, 100 gram purchase. How are you solving a problem for them? And then, but also talk to other clients who you might not think of as being clients. And all of a sudden you discover that somebody you didn't expect to be a client is interested. But their interest might be slightly different than what you originally designed. And now that helps you understand how you might be needing to pivot. And so that goes, I think, very much to your point, is that I started to hear a little bit of that already. I started to hear from banks that, okay, this could be interesting, but I'd like to offer it to the my wealth management clients. How would I do that? Because they're not going to do it through a mobile app. So I'm going to need this, this, and this. And so now that makes you start thinking, oh, so, well, if I can do it through a mobile app, I can do it through a desktop or a laptop, et cetera. And I can still give you the basic foundation of what I'm doing. But maybe I have to give you a few more things because you care about it. So, for example, one of the things that came out was tax harvesting was something that people cared about, and that, if they could benefit from that, that could be relevant. And so that was something we thought about. Or the fact that you could maybe take a loan against that collateral. And so those start to make you move in the direction of what the client wants rather than what I wanted or what I thought was the right solution.
Right. Right. So once again, it's about being out talking to customers.
I think product market fit always comes from talking to customers, and many times it's not what you thought it was going to be.
Yeah.
But the client figures out what their problem is that you might be solving, or you might be close to solving. Right. And you have an opportunity to modify and fix or iterate such that you can, find the solution that does solve the problem for the client.
Right. The transformative insights are often the unexpected insights, the insights that you just happen to be having a conversation with a client and they say something that makes you go, oh shit, that's a really important insight. Yeah.
Yeah. And I think we see this even now, even as we have moved into this more B2B and B2B2C, is that we see this from clients even today, is that it's like, well, that's interesting. Can you do this? How about this? Right. I'd like to use it in this way. Is that possible? Or, so one of the more common requests that we're getting these days is, well, I don't need to buy the gold. I already have it. Can you take the stuff I have and make it functional now?
Oh, that's
so
interesting.
How can you take the stuff I've already got? It's in my house. It's in my safe deposit box, where it's wherever. And, I bought it 10 years ago, but I don't want to sell it. But I want to utilize it. And I didn't realize I could utilize it in a way. So how can we do that?
And so you could accommodate that now.
Yeah, now we can accommodate that. We say, well, actually, we can actually go from analog to digital, or vice versa.
Yeah.
So we can go the entire journey. It's a two-way street. Yep, you've got the physical asset. We can come and we have arrangements. We can collect it in a safe, secure way, insure it, audit it, then get it to the vault, and then make it functional.
Yeah, yeah. So that's a great example of an insight that might not have occurred to you if it hadn't been brought up in conversations with customers.
Yeah. Absolutely.
Yeah. All right, Riz, one last question, and that's advice. If somebody is just starting on their entrepreneurial journey today, what advice would you give them?
I think advice is maybe a couple of things. So one is, be focused on your vision and what it is that you're trying to do to be helpful to the customer. Of course, that's ultimately the end goal, is you got to solve a problem for a customer. So that always has to be the North Star. Um, I think the second thing probably is just realize that whatever it is you started with probably isn't the ideal solution, and you'll have to be willing to iterate and modify, and you'll have to make changes. And again, you have to go back to that first point: listen to the customer.
Right.
Um, and then I think the third thing is it's never about one person. It's always about a team of people.
Yeah.
You need to surround yourself with good people who think differently than you, as well as similarly both, and because you're going to need that, because you're going to make lots of mistakes, and you just don't want the mistakes to be fatal. But mistakes are to be made, and if you don't make any mistakes, then you probably weren't aggressive enough. But most
Right.
likely, you're going to make a lot of mistakes, and those are all learning opportunities.
So team matters. Surround yourself with the right team.
I think team always matters. It's always, I think all great companies are always about the
Yeah.
people. It's not about the company. It's about the people to make the company great.
Agreed. Thanks, Riz. Appreciate it.
Thanks.